All right. Now, this is one of these slides where I say, if you don't remember anything else today, remember these bullet points. And I wish someone had I guess, given me this slide when I first started in business valuation. It's taken me a while to sort of compile these ideas together, but these are very important in my estimation when you're trying to analyze a business and try to take away the concepts of what does all this mean, that this gobbledygook that these ABVs and CVAs are telling me about. Well, number one, a business valuation is essentially the present value of the future expected benefits or cash flow. It's all the future benefits of earnings that business is going to earn over the years. We discount it to present value, and we come up with a lump sum figure to say that business is going to make this amount of money over the future. And business valuation is a future concept. You have to remember that. We may only be valuing a business based upon historical numbers from the past. However, it is a future concept. What is this business going to be worth going forward at a particular point in time, but what's it going to be worth going forward? Because if it's going to fail next week, it's not worth anything today. So that's number one. It's the future cash flows. Number two, to expound upon the first one, in reality, a closely held business is only really worth present value of the future cash flows over and above a normal owner compensation. A normal owner compensation. We'll talk about this a little more later. For instance, let's say we're valuing a plumbing operation, and it's Joe Bob the plumber. Maybe he's got one other employee. They have 2 trucks and they have equipment and wrenches and that sort of thing. Joe Bob pulls out all the profits of the business. He only pulls out about $75,000 a year. Let's say it's legitimate. Let's say he's not running a whole lot of things through his books, which he probably is. But if he isn't, then let's say he's only pulling $75,000 a year. Well, does he just own a job? Probably. Because plumbers, I think, as general knowledge, they make pretty good money. So this particular plumber in this company is only making $75,000. He probably just owns the job, and maybe the business is only worth the equipment, and the truck, and that's about it. Maybe the checking account. So now, if the same plumber is making $275,000, and your average plumber only makes, let's say, $100,000. Well, then there's something else going on there than just owning a job. That company has value over and above that owner. It has some goodwill. We'll talk about goodwill. So, but consider, and I get this question a lot. They'll call up and say, Rob, I got these tax returns. They look, I mean, this guy's not making a whole lot of money. I said, well, he just owns the job. That took 5 minutes to give you an answer, and it didn't cost you $5,000. This concept is that you're only valuing a particular owner's interest, okay? And unless he owns 100%, then you're valuing 100% of the company, he or she. So, and this is important with minority shareholders. In other words, people who own 50% or less of a business. If you're valuing a 10% interest, and you got to look at all the facts and circumstances. If you're valuing a 10% interest, let's say, in a family business, whereas the other 90% is owned by 8 other family members, I mean, if I'm valuing that 10% for the fair market value standard, which you're going to talk about, willing buyer, willing seller, what willing buyer is really going to buy that 10%? I mean, we're not valuing the whole company and multiplied times 10%. What's that? And that's sort of the math, but we'll get to why that's a little bit different for a minority shareholder or a less than controlled shareholder. Because who really wants that? Who really wants that share? It's not just 10% of the whole company. It's that guy's 10% because it's his divorce, or he's the dissenting shareholder, or he's the one that's being oppressed, or he's the one, whatever, that's the subject of some lawsuit. Also, and I guess the final big, if you don't remember anything else today, concept is the ongoing earning capacity. That's the figure that we're trying to get. In this prior example with the plumber, let's say, if he's pulling out $275,000 a year, and the average plumber for that job that he does is only worth $100,000 a year, then we have a $175,000 ongoing earning capacity. That's the dividend. That's the cash flow. That's the number we're looking for to find out what that business is worth. Is the ongoing earning capacity, and I'll show you how we get there.